Why is it that everybody is paying so much attention to the inflation rate? The July inflation numbers came in at 3.2%, which was less than what the market expected, but it actually was an increase from June, which is the first increase in the year-over-year inflation rate since June of 2022. And this is just the official rate. There are other measures of inflation that others say are more accurate that are coming in hotter and some less than the official rate. But why does it matter? Well, it matters because one of the Fed's two jobs that it has is stable prices. Now, to me, stable prices means that prices aren't changing, but to the Federal Reserve, stable prices means prices going up by 2% a year, which means that with the inflation rate ticking back up higher, people are now wondering what that means for what the Federal Reserve is going to do. Does that mean more rate hikes? Does that mean inflation has bottomed out and is headed higher from here unless the Fed gets more aggressive with tightening? And obviously the reason why that matters is because the more expensive debt gets, the more in pain, economically speaking, actors are who are over leveraged, like the government, corporations, and households. So we're going to take a look at what the real inflation numbers are, where we're headed from here, and what the Federal Reserve is going to do about it, both in the short term and in the long term. If you don't know who I am, my name is Joe Brown, and I run Heresy Financial University, where I teach active investors how to get higher returns by taking on less risk with their portfolios. I do this through a number of courses that I have published. Members get access to the entire training library, and you get access to all current and future courses, some of these being portfolio allocation, advanced investing strategies like options, hedging, income strategies, fundamental analysis, retirement accounts, getting out of debt, and much more. If you're interested, sign up with the link in the description below. The US Bureau of Labor Statistics publishes the Consumer Price Index, and the chart that we're looking at here shows the prices relative to what they were 1 year before. So as of July, prices were 3.2% higher than what they were in July of 2022. However, June, the month prior, prices were only up 3% higher than a year earlier. This is the first time since June of 2022 that the inflation rate actually increased. Now, when the line is going down, that's what we call disinflation. Prices are still going up, they're just going up at a slower pace than they were before. So from June to July was the first time we did not have disinflation since June of 2022. But outside of official circles, very few people agree that the CPI is an accurate representation of inflation. Take, for instance, Trueflation, which is currently showing year-over-year inflation of 2.37%. And just in case you think that this is a source that is constantly trying to understate what inflation really is, all we have to do is take a look back at just a year ago, where they were reporting inflation over 10% in August. At that time, the official inflation rate was showing only 8.3%. So even though Trueflation may not be constantly leaning to one side or another, you still may disagree with their methodology, and that is fine. The fact of the matter is there is no such thing as one inflation rate for everybody, because everybody has a different cost of living, because everybody needs to buy different things. For instance, if you live in a dense city and you ride a bicycle everywhere, then the cost of gasoline probably matters very little to you. So everybody has their own inflation rate. The best we can do is come up with an average number that is the least incorrect. But there's good reason to think that the real inflation rate may be lower than what the CPI is saying as of today. Not always, but at least for right now. One of these reasons comes when you exclude shelter data from the CPI. This chart posted by Jay Parsons on Twitter shows that excluding shelter, CPI is currently right at 1%. And if you're curious why you would ever need to exclude that from the data, it's because there's a 12-month lag between asking rents and CPI rents. And as asking rent growth continues to cool, CPI rents are going to follow. Now, when we look at this from an economic perspective that understands the effect of the money supply, this certainly makes sense, and it may even mean that very soon we are going to see some deflation. Not disinflation, but actually prices dropping. But first, a quick word from today's sponsor, One Gold. I have personally used One Gold for quite some time, and for good reason. And the main reason is it's just not smart to have all your eggs in one basket. Many people, for many different reasons, use storage in addition to physical gold. All it takes is one bad actor to find out that you may have gold in your home, to come in and try and find it, putting your life potentially at risk. It's one of the reasons why those gold bars that you see behind me in all my videos are fake. They're plastic. Considering I'm constantly putting myself out there in the public, it would not be smart for me to have $3 million of gold sitting on a desk behind me. And it's why I personally don't keep any physical gold in my office or at my home. In my specific situation, it would not be safe or smart. Now, for others, it might not be that exact same situation, but maybe you live in an apartment, maybe you travel all the time, or maybe you're in an area where there might be a storm or a fire that could burn down the building, knock it over, and some of the rescue crew just happens to find what you had stored before you can get home. For many people, it is important to have physical gold, but don't keep all your eggs in one basket. Diversify with storage. All metal positions at One Gold are fully insured against theft, damage, and physical loss. And that's on top of the fact that the gold is already allocated and segregated. Now, security is far from the only reason that storage makes sense. Many people like to dollar cost average in, or maybe they just don't have enough to be buying a full ounce at a time or a full 10 ounces if you're doing something like silver. So they dollar cost average in, and once you have a sizable stack, then it makes more sense from a premium standpoint to request physical delivery. And One Gold gives you the option to choose between countries you store your gold in, including the US, Switzerland, Canada, and the UK. So for dollar cost averaging, peace of mind, security, and storage in another nation, One Gold gives you peace of mind. Sign up with the link in the description below. It is certainly true that many things have an influence on the rate of inflation, but one of the largest pieces of that puzzle is always going to be the money supply. Ever since the United States came off the gold standard, it has allowed the Federal Reserve to expand the money supply with nothing anchoring it down. But something is happening right now that has not happened in decades. The money supply is shrinking, and it may not look like it relative to the expansion of the money supply in the past, but make no mistake, the money supply is contracting. If we take a look at the percentage growth of the money supply, we can see that since 1982, when the Fed began tracking this data, the money supply has never shrank. There are other sources of data that look at the money supply going back much farther, and looking at this black line in 1933, we can see that was the last time the growth rate of the money supply was negative. So just to put this in perspective, right now, the growth rate of the money supply is negative, and the last time it was negative was 1933. Do you remember what was happening in 1933? Just a little thing called the Great Depression. This is a direct result of the tightening the Federal Reserve has been doing with raising rates and letting assets bleed off its balance sheet. There is simply less money in circulation, less money in existence. All else being equal, this does drive prices down. So far, it's driven the rate of inflation down, but keep it up long enough and it actually drives prices down as well. Now, you may be wondering about the increase in the inflation rate. After all, if this was true and the money supply was going to dictate the inflation rate, why would we see an increase in the inflation rate from June to July? Wouldn't that instead indicate that inflation has bottomed and is going to be heading up higher from here? Well, maybe, but maybe not. By the way, guys, I'm going to be speaking at the Stock Pulse Silver Symposium about the history and future of sound money. It's in Las Vegas from September 29th through October 1st. There's going to be a ton of other great speakers there. There are going to be plenty of opportunities for us to do meet and greet, hang out, get some drinks together. I'd love to meet you there. And everybody who shows up is going to get 1 ounce of silver as well, a 1 ounce silver coin. So I'd love to see you there. There's a discount link, 10% off in the description below. So sign up there, get that discount, and tickets are running out, so sign up soon. This chart from tradingeconomics.com is showing the month over month rate of inflation, meaning instead of comparing prices today to prices a year ago, this chart is comparing prices today to prices a month ago. One thing that's interesting is July of 2022, which showed a 0% month over month inflation. That means from June to July of 2022, prices were flat. They didn't change for that month. If we plot this on a line graph showing the absolute level of prices, we can see that from June to July, prices were indeed flat. But since then, prices have started going up again. So it actually makes sense that we would see an increase in the rate of inflation because we are coming off of a lower base. The month of June was measuring after an increase a year ago, but the month of July, year-over-year inflation rate that we're measuring, is measuring from a year ago in which prices did not go up that month. And so year-over-year inflation for July would be expected to come in hotter than June, simply because of what happened a year ago. So what's going on right now is not a surprise and is in no way an indication that the inflation rate has bottomed. We should still expect the inflation rate to move lower from here. And if the money supply historically has anything to say about this, we would expect even deflation, maybe even before the year ends. Now, what is the Federal Reserve going to do about this? That's the big question. Well, after this higher inflation reading, I think this is giving the Federal Reserve the room to do one more rate hike. But following that, it's been pretty clear that the Federal Reserve is moving to try and target a consistent real interest rate rather than just moving rates nominally. To explain what real versus nominal rates mean, if the interest rate is 5%, but the inflation rate is also 5%, well, that means if you have $100 this year, you'll have $105 next year because you loan your money out at 5%, but also means that prices went up at the same pace. So you can buy the exact same amount of stuff with that $105 this year that you could buy last year with $100, meaning your purchasing power didn't change. So if the interest rates match the rate of inflation, that means the real interest rate is actually 0. Right now, the federal funds rate is at 5% and the inflation rate is at 3.2%, which means roughly interest rates, the real interest rate is a positive 2%. Now, this wasn't true for many years. For many years, the real interest rate was actually negative. Consider June of 2022 when the official inflation rate was 9%. At that time, interest rates were only 1%. So in real terms, interest rates were negative 8% at that time. But now that interest rates are positive from a real perspective of about 2%, it seems like the Federal Reserve is going to try and keep interest rates there from a real perspective, which means if inflation hits 1%, then we could very easily see the Fed drop interest rates to 3%. And that's still positive from a real perspective. From a real perspective, it's actually no change from today. This also means that if the inflation rate drops to negative territory and becomes deflation, let's say dropping by 2%, then the Federal Reserve could drop interest rates all the way to 0%. And on an inflation adjusted basis, interest rates would actually still be 2% positive, the same as they are today. Now, I'm not saying that that wouldn't have any stimulative effect. I am saying though that the Federal Reserve, Powell specifically, has mentioned this in the past, saying if we lower rates, let's say in 2024, it would only be to maintain the same real interest rate. So he's already begun prepping economists and the markets for this. So far we have inflation rate moving down, dipping over into deflation, and the Federal Reserve potentially dropping interest rates in order to keep things as similar as the same as they can. But what happens next? Well, there are two wild cards that we have to look at to what happens after that point. One of them is velocity and the other one is the government deficit. For the most part, since 1997, the velocity of the money supply has been on the decline. There was a brief period preceding 2006 in which velocity increased, a brief period in 2009 where velocity increased, and a brief period in 2017 where velocity increased. But over the long term, the trend has been overwhelmingly down with velocity. For those of you who aren't aware, velocity is simply the rate at which money is circulating in the economy. It's calculated as the ratio of the GDP compared to the money supply. But it's noticeable now that the trend in the velocity has reversed. Ever since Q3 of 2021, velocity has been on the rise at a very quick pace. This means that right now, even though the money supply is shrinking, people are spending money faster. That money is circulating the economy quicker than it did before. Now, it's true that if you draw a straight line from 1997 to where we're at today, that trend line shows that we are just back up to where the trend was before. So we're certainly not above trend yet. But if the last couple quarters keeps up, we could very easily see this move higher, and this could combat prices falling. Now, I need to make a note about velocity because so many people misunderstand this, and I have corrected this on many videos in the past, but velocity being there or not being there is not a necessary condition for prices going up or down. A change in velocity certainly can have some influence over prices, but you don't need velocity to get inflation, and certainly you will not absolutely get inflation just because you have velocity. In fact, after the massive drop in velocity in 2020 and velocity staying low through 2021, while at the same time seeing the largest rise in the inflation rate in modern history, it's quite shocking to me that anybody still thinks velocity is necessary. At most, it has some influence. And the final wild card here is government deficits. The amount of money the government has to spend is increasing every single month, not because it has to spend more on all the stuff it normally spends money on, but because the interest rate on its total debt pile is increasing. Currently, interest rates are between 4 and 5% for government debt, but interest rates used to be much lower, even closer to 0%. So that $32 trillion of national debt that the government has right now, much of it was borrowed all back here when interest rates were much lower. Every month, the government has to pay off some of that old debt, which was cheap debt, and they're borrowing new expensive debt to do that. This means that even if the government magically tomorrow balanced their budget and stopped borrowing more, their spending would still have to increase because they still have to pay off the old debt. And a balanced budget just means not adding new debt. So they'd maintain the same debt, but their spending would have to go up, which would mean in order to do that, they would have to stop spending as much on all the other categories, which they're definitely not doing. Now, in the past couple of weeks, I've made a few videos explaining this whole thing in depth, so I'd suggest going back and watching those to understand the full implications of this. But in short, within 1, 2, or 3 years, the government will have to borrow so much money in order to just pay the interest on the debt, it won't be able to afford to do so. Interest rates will be too high for them to actually afford borrowing that. If left alone, this means the government defaults. It can't pay its bills. But you and I both know it won't come to that. At that point, the Federal Reserve will step back in, resume quantitative easing or yield curve control, and print the money the government needs. That is the point at which deflation ends. That is the point at which we tip back over into inflation. We'll start to see a re-expansion of the money supply yet again, as the government will print what it needs for all of its expenses. Because of the size of this debt relative to GDP, this will last for at least a decade, but probably more. Meaning over the long term, we are headed into an environment, a long-term cycle of interest rates and inflation both moving higher. So for the next couple of months and next couple of quarters, the inflation rate should continue to move down and will probably tip into negative territory. Interest rates may also follow suit. But the fiscal spending, the federal government's expenses, is the largest factor macroeconomically speaking, most significant thing driving all of this. And when push comes to shove and they're forced to choose between printing and default, you and I both know which ones they'll choose. And if you're curious about what I'm doing and what all the members of Heresy Financial University are doing with their portfolios to protect themselves from both deflation and inflation, market melt-ups, and market crashes, you know what to do. Sign up for Heresy Financial University, linked in the description below. As always, thanks so much for watching. Have a great day.